4 weeks left basically in the year. What can be saved?
So I think lots going to depend on what happens this coming week, right? We have the G20 meeting. A lot of eyes are on that in terms of the outcome between Trump and Xi's negotiations, what Powell says on Wednesday when he gives a speech. Does he strike a little more dovish tone? What happens with oil? So there's a number of factors. I think people right now are kind of in wait-and-see mode. If we get good news, I think you're kind of set up for a nice kind of Santa Claus rally through year-end.
Directionally, though, you're betting on something better, more good than bad?
We are betting on that, but it's like kind of a 6-month view, right? There's a lot of sort of uncertainty, but we feel like a lot of news is already in the price. And so even if trade doesn't sort of get better, a lot of bad news is in the price. So it's kind of skewed asymmetric to the upside. A lot of bad news is in the price. If things kind of play out in terms of trade getting better, the Fed is a little more dovish. We feel like there's more upside over the next 6 months. Next few weeks, a lot of volatility, hard to say, but I think on a 6-month horizon, we're pretty comfortable with that call.
Jim, a lot of the macro strategists are putting out their books for the next year. And they're fairly cautious. Morgan Stanley underweights U.S. today. B of A's 12-month target, 2,900. How do you think the next year is shaping up?
Well, I think, Carl, that we're going to have, I think, slower growth and in the United States as well as the rest of the world. I think maybe over the next 12 months, slowing like to 2%. I think the interest rate structure that's come up so much across all yields, across the yield curve is already slowing interest-sensitive spending. That's showing up in the data. I think the dollar strength this year is going to slow manufacturing, industrial activity. And I think that the combo is going to slow overall more than expected. I think the issue for next year is if we slow growth down to around 2%, will that bring interest rates down? Will it stop the Fed? Will it stop inflation from creeping higher? If it does, then we could have a decent rally. But if it doesn't, if we slow growth and the 10-year yield stays, about where it's at, around that 320, 325 area, or creeps higher, and wage and core inflation creep higher, then I think we've got further to go. On the downside, I still think we might have a further deeper correction and then maybe a decent second half of 2019. That'd be my guess.
Jason, does the Fed raise rates next month?
It raises rates next month. The economic data in terms of labor market, inflation data, it's right there. So they're going to raise rates. The market's kind of primed for it, so they're going to take advantage of that. But they can kind of give guidance and commentary to say, we're going to be a little more cautious on March, assess the data. But I think if they have a window of opportunity to raise rates and the goal is to raise rates, they're going to take that chance right now.
Jim, earlier on our last hour, we were talking about the fact that there's been nowhere to hide this year. I mean, not bonds, not commodities. If you had to pick an area where you'd want to be in terms of trying to gain a return as you look ahead, what would it be?
Well, I think right now, David, I'd be defensively positioned. I'd have a little cash here, maybe some intermediate, bonds. I would move away from the United States. It's really interesting to me. We've had 10% correction, and the emerging markets have outperformed the U.S. stock market. That might say something about how washed out those markets are. So I'd have a tilt that way. I'd certainly be overweighting more defensive sectors here. I know they've done well, but utilities and staples, stocks, the dividend aristocrats, the low vol sort of things. I might be tempted to start picking away at things like the energy stocks here or material stocks in lieu of, I think, inflation continuing to be an issue next year. But it's been tough overall. And I think what we have to do is get a bottom in this equity market, and then we can get back to assessing whether you want to get risk on again. But until we do that, I think it's going to continue to be a difficult investment environment.
Jason, I'll put the same question to you. Where do you put your money right now?
We still like owning equities on a 6 to 12-month horizon. If we think back to like 2015, that was last year, which every single asset class was basically flat or negative. And that's kind of where we ended up this year. So the chances of us being sort of flat or negative across all asset classes over the next 12 months, it's quite low. Also, in terms of rates, a lot of news is already in terms of the price. The market's basically pricing the Fed to go to 3 hikes, get to 3%, and then stop. So if we just think about the rate move we had this year, if nothing else changed in terms of the earnings outlook, we'd estimate that the S&P would be down about 20% just based on that rate move. So if we've already kind of absorbed that big move in rates, they're kind of going to plateau next year, which I think is a reasonable bet. Then you just have to have decent earnings growth, no valuation expansion, your dividend yield, you're looking at mid to high single digits for equities. Not spectacular, but I think still a solid return.
Your point, your line about you need decent earnings growth is key, because we've already gotten some calls today, for example, that 50% plus chance of a earnings recession. 2 quarters of negative growth next year out of Morgan Stanley. You think that's ridiculous?
We think it's a little extreme. I think we're on the conservative side looking at 4% earnings growth next year, and that includes sort of impact from the tariffs. Bottoms up are still around 8 or 9%. That's likely to come down. So suppose it gets around 5 or 6. Get that earnings growth, get a 2% dividend yield, you're looking at a 7% return. Not spectacular, but that's still, a solid place to put your money.